If you're an owner-operator pulling in over $80,000 a year and you're not doing this one thing on your taxes, the IRS is quietly taking $11,000 from you every single year. Your accountant won't tell you because they don't know either. Look, most truckers hit the highway, track their diesel receipts, log their maintenance, and think they're doing everything right. But there is a massive structural tax mistake that costs independent drivers over $50,000 in a lifetime, and it has absolutely nothing to do with fuel or tires. Think about the miles you put in, the 14-hour shifts, the bad weather, the traffic delays, the shipping docks that make you wait for hours without pay, and the weeks spent away from your family. You push your body and your rig to the absolute limit to keep freight moving, but at the end of the quarter, when you look at your settlement sheets and what you owe the government, it feels like you're working for the IRS instead of yourself. Here's the cold, hard reality. When you work as a 1099 independent trucker or an owner-operator, you aren't just a driver anymore. You are a business entity, but nobody hands you a business degree when you get your CDL. Most drivers start out filing their taxes as a simple sole proprietorship because it's easy. It requires no heavy paperwork, no corporate filings, and no extra fees. But that exact convenience is a financial trap. When you file as a sole proprietor, you get hit with the full weight of self-employment tax on every single dollar your truck clears. That is a flat 15.3% on top of your standard federal and state income taxes. You are essentially volunteering to hand over an extra $10,000 to $12,000 a year in unnecessary tax leaks simply because of how your business is legally structured on paper. Today, we are putting an end to that leak. This isn't generic financial advice from someone who has never seen the inside of a truck. This is a structural blueprint designed specifically for independent operators to legally shield their hard-earned money and stop the bleeding before the next quarterly deadline. Let's break down the first and most critical step of this strategy, which is the S-Corporation shift. If your truck is clearing a net profit of around $60,000 to $70,000 after basic expenses, staying as a sole proprietor or a basic single-member LLC is financial suicide. When you operate as a sole proprietor, if your net profit is $80,000, the IRS calculates your 15.3% self-employment tax on that entire $80,000. That's over $12,000 down the drain before you even calculate your regular income tax brackets. By changing your tax status to an S-Corporation, you fundamentally change how the IRS views your money. Under an S-Corp structure, you become an employee of your own trucking business. This allows you to split your business income into two distinct categories, which are a reasonable salary and corporate distributions. Why does this matter? Because you only pay that heavy 15.3% self-employment tax on the salary portion, not on the distributions. Let's run the exact math so you can see how the $11,000 stays in your pocket. Imagine your truck nets $80,000 this year. Under your new S-Corp, you pay yourself a reasonable salary based on industry standards for a driver. Let's say $45,000. You run payroll, pay the employment taxes on that $45,000, and everything is completely clean. Now, what happens to the remaining $35,000? That remaining $35,000 is taken out as a business distribution. The IRS legally allows corporate distributions to bypass self-employment taxes completely. You still pay regular income tax on it, but you have successfully shielded that $35,000 from the 15.3% self-employment tax. That single corporate adjustment saves you roughly $5,355 in a single year. Over a 5-year period on the road, that's over $26,000 of your money that stays in your bank account, generating interest or going toward paying off your equipment instead of funding government spending. But why doesn't your regular neighborhood accountant set this up for you? Because standard tax preparers are built for volume. They want to process standard W-2 forms and basic retail filings as fast as possible during tax season. They don't look at the corporate scaling of an independent freight business, and they don't want to deal with the quarterly payroll compliance that comes with an S-Corp. If your CPA hasn't brought this up to you, it's time to start asking harder questions. The second pillar of stopping the $50,000 tax mistake is maximizing the per diem deduction properly. The IRS knows that logistics workers face massive, non-reimbursed costs while keeping the supply chain moving. Because of this, they allow a standard daily allowance for meals and incidental expenses whenever you're traveling away from your home base. Currently, the standard IRS per diem rate for the transportation industry is one of the most powerful tax deductions available to independent drivers. For every full day you spend on the road outside of your tax home, you can claim a deduction. But here is where owner-operators leave thousands of dollars on the table due to bad logging. Most drivers assume that tracking their actual fast food receipts or diner bills is the best way to do it. This is a massive mistake. Actual receipts limit you to what you actually spent. If you bought a cheap $5 meal, your deduction is $5. But if you use the standard IRS per diem method, you get to deduct the full daily allowance set by the government regardless of whether you spent that much or not. If you are on an over-the-road run for 250 days out of the year, that translates to an automated deduction of nearly $17,000 to $18,000 straight off your taxable income. To maximize this safely without triggering an audit, your electronic logging device, or ELD, is your ultimate shield. The IRS does not require food receipts if you're utilizing the standard per diem method, but they absolutely require proof of time, place, and business purpose. Your logbook must perfectly align with the days you are claiming. If your logs show you were shut down at a truck stop in Ohio, but your tax filer claims a home base expense that day, the system flags it. Furthermore, you need to understand the partial day rule. The day you leave your house to start a run and the day you return home are calculated at 75% of the standard daily rate. Regular accountants often skip these partial days entirely because they don't want to cross-reference 300 pages of ELD records. They just take a rough guess or skip it, which costs you hundreds of dollars per trip. If you track every single start day and end day accurately, those partial numbers compound into a massive tax shelter by the end of December. Now let's talk about the structural write-offs that go far beyond standard maintenance and fuel tracking. Every independent driver knows they can write off their diesel, their commercial insurance, and new brake pads. Those are obvious. But true wealth optimization comes from tracking the operational costs that occur outside the cab. First up is the home office deduction. Many owner-operators believe that because they live in their truck for weeks at a time, they cannot claim a home office. This is completely false. If you use a dedicated area in your house to manage your freight contracts, communicate with brokers, file your IFTA reports, and handle your corporate bookkeeping, that space constitutes a principal place of business. This allows you to write off a percentage of your rent, your mortgage interest, your home utilities, and your internet services based on the square footage of that office. If you pay $2,000 a year for high-speed home internet so your family can use it, but you also use it to secure loads and manage compliance, a significant portion of that bill is now a legal business expense. Next is communications and electronics. Your smartphone, your iPad used for routing, your satellite radio subscription, your dash cameras, and your electronic logging hardware are 100% deductible business expenses. If you purchase a premium cell phone plan to stay in contact with dispatchers and check load boards across state lines, that entire plan is an operational expense. Even the tools and comfort items inside your sleeper berth are deductible. Did you buy a portable refrigerator to keep food cold on long runs so you don't have to buy overpriced food at truck stops? That refrigerator is a business asset. Did you buy a specialized mattress to prevent back pain while sleeping at rest stops? Did you buy tools to handle quick roadside repairs so you don't have to pay a commercial mechanic $500 to change a simple hose? Every wrench, every socket set, every cleaning supply, and every truck wash service is an arrow in your quiver against the IRS. When you fail to systematically log these micro expenses, you aren't just saving time, you are handing your profits straight back to the government. Building wealth as an owner-operator isn't just about finding the highest paying loads or burning less fuel, it's about asset protection and wealth retention. You can pull in $200,000 a year in gross revenue. But if your corporate structure is weak and your deductions are unorganized, you will take home less money than a company driver who has zero equipment liabilities. Stop letting your hard-earned cash leak into the hands of the IRS because of poor paperwork or an inexperienced accountant. You are taking all the risk on the highway, so you should be keeping the rewards. To help you fix this layout before the next tax quarter closes, I've put together a comprehensive, step-by-step, free trucker tax and deduction checklist. This is the exact playbook built for independent owner-operators. It breaks down the corporate transition requirements, lists every single hidden write-off you can legally claim, and includes an ELD per diem tracking template that you can hand directly to your CPA to ensure nothing is missed. Click the link in the description or the pinned comment right now, drop your email, and download the checklist completely for free. Take control of your structural finances, stop the $11,000 annual leak, keep your hard-earned cash, and drive safe.